Have you ever looked at your bank app, literally just pixels on a screen, and wondered, how did we actually get here? Welcome to this explainer. Today we're unpacking the absolute everyday miracle of money. We're going to trace a wild 2,500-year evolution, relying on some incredible historical and anthropological sources to see how human trust literally became our ultimate currency. So let's jump right into the big question. How was money actually invented? Now, if you're thinking it was to fix some clunky barter system, trading 3 arrowheads for a beaver pelt because someone got annoyed, well, you're about to be pretty surprised. It's the story we've all been told for sure, but the actual historical evidence points to a completely different and honestly way more fascinating origin story. For years, traditional economics has been teaching Adam Smith's barter myth, the idea that early humans just directly swapped goods until it got too frustrating. But when we look at the work of anthropologist David Graeber, a totally different picture emerges. His research reveals that early communities actually operated on broad, informal systems of non-enumerated credits and debts. What does that mean? Basically, they operated on favors. It was all about community trust, not spot barter transactions.
Here is our roadmap for today's explainer. 1. The myth of barter. 2. Lydians and first coins. 3. China invents paper currency. 4. Rise of Medici banking. 5. The double entry revolution. And finally, 6. Trust, the ultimate currency. Section 1. The myth of barter. Trust before money. Let's totally debunk this barter myth right now. 0%. That's a massive number, right? Well, according to comprehensive anthropological studies, out of thousands of cases studied, exactly 0% of historically observed non-monetary societies relied purely on spot barter transactions. As Cambridge anthropology professor Caroline Humphrey pointed out, no pure barter economy has ever been described. Imagine living in a tiny ancient village. If you wanted your neighbor's pig, you didn't haggle over exactly how many chickens it was worth. You might just heavily praise the pig, they'd hand it over as a gift, and boom, now you owe them a favor down the line. It was an entire economy based on community trust. Actual barter? That really only happened between complete strangers or enemies who didn't trust each other at all.
Section 2. Lydians and first coins. Standardizing trust. So, if we didn't actually need money for local trading among trusted neighbors, how did we end up with physical coins? Well, it started around 650 to 600 BC. The ancient kingdom of Lydia created a financial technology that sparked an absolute revolution. From their home in Western Asia Minor, this breakthrough spread like wildfire. The Greeks eagerly adopted silver coins in the 6th century BC, and by the 5th century BC, the seafaring Phoenicians were spreading them all across the ancient world.
The Lydians were incredibly innovative. They had access to the Pactolus River, which was basically packed with electrum. That's a naturally occurring alloy of gold and silver. But instead of weighing out random chunks of precious metal for every single transaction, Lydian authorities did something genius. They started stamping these electrum pieces with a specific image, like a lion's head, which guaranteed their weight and purity. And just like that, coins turned abstract trust into a standardized, interchangeable unit of account. This was a massive game changer, especially for kings who needed to pay large standing armies. Because, let's be real, a hired mercenary from 2 towns over, he doesn't want your informal village IOU. He wants hard, standardized currency that he can trust absolutely anywhere.
Section 3. China invents paper currency, abstracting value. Now, physical metal is great, but it has one massive flaw. It is incredibly heavy. Just imagine trying to run a business and having to lug around thousands of heavy copper coins, which is exactly what merchants in pre-modern China had to do. Or even worse, dealing with 17th century Swedish copper plates that literally weighed several kilograms each. Just carrying that around is a nightmare. The physical toll, not to mention the risk of getting robbed on the road, was astronomical. Merchants desperately needed a lighter alternative to keep commerce growing. To solve this massive friction, we have to look at the Song dynasty in 11th century China. They introduced jiaozi, the world's earliest paper money. It actually started as merchant deposit receipts, but the Song government eventually stepped in, monopolized the system, and started producing state-issued paper banknotes. Thanks to widespread woodblock printing, they successfully abstracted value from heavy physical metal right into lightweight paper. Now, the physical paper itself, practically worthless, but the trust in the state that backed it, that is what gave it tremendous power. Moving on to Section 4.
Rise of Medici banking, the network of trust. Meanwhile, over in Europe, figuring out how to safely move physical wealth led to the birth of the first modern banking empire. Founded in 1397 by Giovanni di Bicci de' Medici in Florence, the Medici Bank grew into the largest, most respected institution in 15th century Europe. Now, here's a fun fact. At the time, charging interest, which they called usury, was strictly banned by the Christian Church. But the Medici and other Italian bankers, they were brilliant. They bypassed these bans using clever legal loopholes like the contractum trenulius. They basically disguised their interest as insurance against loss or delay. It was a workaround that famously made them the Pope's usurers. But their real innovation was pioneering correspondent branch networks across major hubs like Rome, Venice, and Bruges. Instead of shipping heavy chests of gold across roads filled with bandits, they handled international remittance via bills of exchange. Basically, they invented the Renaissance version of the international wire transfer.
Section 5. The Double Entry Revolution, the Ledger of Trust. So to manage this giant, sprawling international network, the Medici popularized a technology that literally changed everything.
That game changer was double entry bookkeeping. It's an accounting system that tracks both debits and credits for every single transaction. Simply put, if money goes out of one account, it absolutely must perfectly balance by going into another. And this wasn't just some neat math trick. It was the revolutionary operating system of the entire Renaissance economy. It mathematically guaranteed that every single deposit and withdrawal was rigorously accounted for, which dramatically boosted the trustworthiness of these financial institutions.
In fact, the historian Raymond de Rover highlights that there's a surviving fragment of a ledger from the Medici's Bruges branch, and it perfectly proves their absolute mastery of this double-entry system. This piece of accounting tech allowed the Medici family to manage unbelievable levels of uncertainty and intricately control risk across all their European branches. It proved that you didn't actually need to physically hoard your gold to know it was safe, you just needed to trust the math. Which brings us to Section 6, Trust, the ultimate currency, the modern fiat system. Let's fast forward to the modern era and see how all this history builds the money we use today. For a very long time, paper money in the West was backed by actual physical metal. During the 19th century, industrial nations adopted the gold standard. Then, after World War II, the 1944 Bretton Woods Conference pegged most global currencies to the US dollar, which was, in turn, fixed to gold. But in 1971, everything changed. The US officially suspended the convertibility of the dollar to gold. Almost overnight, the entire world transitioned to a completely unbacked currency system. And that brings us to fiat money. The crucial thing to understand here is that today's money possesses exactly zero intrinsic use value. You can't eat a dollar bill, and you definitely can't build a shelter out of the digits sitting in your banking app. It has value entirely because of government decree, or fiat. Plus, as proponents of modern monetary theory point out, this currency maintains its value because the state demands that you pay your taxes in it. That creates a mandatory, unavoidable demand. Its value is, at its core, purely a social convention that we've all just agreed upon. As we wrap up this explainer, I want you to literally pull out your wallet. Look at the paper or plastic inside. What is it actually worth if trust disappears? Absolutely nothing. The remarkable truth is that from the informal, unwritten favors of our ancient ancestors, to the stamped electrum coins of the Lydians, through the beautifully balanced ledgers of the Medici, right up to the invisible digital fiat system we use today, the true foundation of all finance has always been and will always be human trust. Thanks for joining me on this explainer, and keep questioning those everyday miracles around you. Welcome to this explainer. Today, we're going to uncover how the absolutely brilliant financial innovations of the 17th century immediately paved the way for crowd psychology, speculative manias, and devastating crashes. It's this fascinating story of human ingenuity colliding head-on with human greed. And honestly, the ripples of these early events, we're still feeling them in every single financial center on Earth today. Let's kick things off with a pretty wild question. What does a 17th century flower actually have in common with a modern tech stock? Well, the answer reveals that the whole boom and bust cycle of modern Wall Street actually started over 400 years ago in the Netherlands. We tend to think of complex financial markets as a very modern invention, right? But as you'll see, the very first speculative bubbles were built on the exact same human behaviors that we see flashing on our trading apps today. All right, Section 1, the first stock market. Let's head straight back to the Dutch Republic to see exactly how the absolute foundation of global share trading was built. Just take a look at this timeline, because it brilliantly illustrates the staggering pace of Dutch problem solving.
In just a single decade, they created the first public company, the first stock exchange, and the first settlement bank. They were facing this massive challenge, right? How do you fund incredibly expensive and risky trade missions to Asia without completely bankrupting the organizers if a ship sinks? Well, their solution was to crowdsource the risk, and in doing so, they literally laid the groundwork for the modern economy. Here's the real game changer. The Dutch East India Company, or the VOC, basically invented the modern corporate structure out of sheer necessity. Before 1602, trade missions were funded on a strict per-voyage basis. But by issuing shares and setting up a permanent capital structure by 1612, the VOC let investors buy a stake in the company's long-term success. And most importantly, this is absolutely crucial, it introduced limited liability. That meant you could only lose what you invested, which protected everyday investors from total ruin.
And the innovation definitely didn't stop at stocks. Historical source documents detail how by 1683, the Bank of Amsterdam actually limited its depositors' ability to withdraw coin. What they were doing was effectively creating an early system of fiat money, a virtual collateral whose value just derived from law and custom. This injected massive liquidity into the market, allowing the bank to act almost exactly like a modern central bank, smoothing out the money supply. Moving right along to Section 2, going short in the 1600s. Let's see how quickly traders learned to exploit these brand new tools for a speculative edge. Because wherever there's a market, there are people looking to game it. You look at this list and you probably think of modern Wall Street, right? Options trading, margin calls. But actually, scratch that. These complex financial derivatives were daily practice in 1680s Amsterdam. The unit value of a VOC share was incredibly high, which gave traders a huge incentive to create derivatives, just so they could afford to play in the market or hedge their bets. Check this guy out, Isaac Lemaire. Way back in 1608, he was already making the practice of short selling infamous. He was borrowing shares, selling them in hopes the price would drop, and planning to buy them back cheaper. He was so aggressive with this tactic that the Dutch government actually tried to step in and ban the practice entirely. So yeah, the whole concept of betting against a stock is literally as old as the stock market itself. Okay, with the mechanics of speculation firmly in place, we arrive at Section 3. Tulip mania, madness, or fundamentals. We've all heard the wild stories of people trading houses for flower bulbs, but we really need to ask, was it truly madness or just misunderstood economics? To figure this out, we have to look at a classic debate. On one side, we have Charles Mackay's popular Madness of Crowdsmith from the 1850s. And on the other, we have modern, rigorous research by economist Peter M. Garber. For over a century, Mackay's dramatic retelling has been taken as gospel. But when we actually dig into the market fundamentals of the 17th century, a completely different, much more rational picture starts to emerge. So Mackay popularized these incredibly dramatic anecdotes. He wrote about a sailor mistakenly eating a massively valuable tulip bulb for lunch, thinking it was an onion. He also claimed the bubble's collapse led to a prolonged economic depression in Holland. But here is the catch. Mackay provided almost no source data or verified dates for these extreme prices. Plus, economic historians have noted that the Dutch economy actually continued to boom long after the tulip market supposedly ruined everyone. Garber points out something super fascinating. Those genuinely high prices, they were strictly for rare, beautifully patterned bulbs. And those patterns were actually caused by a mosaic virus. This virus made the bulbs incredibly difficult to reproduce, while also weakening the plant. So to elite collectors, these weren't just standard garden flowers. They were incredibly rare, highly perishable luxury goods. Having a high initial price that rapidly depreciates as a flower becomes easier to cultivate is actually standard pricing behavior in the floral industry, even today. Now, there was a bubble, for sure, but it was incredibly brief. It literally only lasted for the final 30 days of the speculation window, right in early 1637. During this tiny one-month window, everyday people without any real net worth started trading futures contracts on common, unplanted bulbs in local taverns. They were essentially making million-dollar bets on credit, completely untethered from the actual floral industry. And when the buyers finally dried up, that specific, highly leveraged tavern market collapsed overnight. All right, let's fast forward a bit to Section 4, the South Sea Bubble. We are going to witness what happens when a government and a massive corporation conspire together to create an absolute speculative frenzy. So the British explicitly copied the Dutch joint stock model to create the South Sea Company in 1711. The big goal was to manage the massive national debt they'd accrued during the War of the Spanish Succession.
They were granted a monopoly on trade in the Americas, which included the highly lucrative slave trade. But when Spain severely limited British trade access, those expected profits completely failed to materialize. So what did they do? Instead of trading goods, the South Sea Company just started trading its own stock against the national debt. To keep the whole scheme alive, the company relied on pure hype and rampant bribery of parliament members. King George himself even took the governorship of the company, giving it the ultimate royal endorsement. Driven by this completely manufactured confidence, the stock price became entirely untethered from reality. By August 1720, the price of a single share hit a staggering £1,000. But you know how this goes. The company cannot survive on hype alone. When reality set in and the bubble burst in September, the resulting crash was catastrophic. People from all classes were completely wiped out. The mania was so infectious that even the brilliant physicist Sir Isaac Newton succumbed to the groupthink. He bought in at the top and lost an estimated £40 million in today's money. It just proves that even the smartest people on Earth aren't immune to the psychological pull of a market mania. And the irony here is just perfectly tragic. The collapse was actually triggered by the South Sea Company's own greed. Hundreds of other copycat companies had sprung up, and to crush them and redirect all that capital back into their own stock, they lobbied Parliament to pass the Bubble Act. But the act just caused massive panic. Investors started rapidly deleveraging and pulling their capital out of everything. That accidentally sparked a massive market contagion that ultimately took down the South Sea Company itself. Which brings us to our final takeaway in Section 5, when greed breaks the system. We've looked at the creation of these markets and their very first failures, but what we're really observing is how our exact same human behaviors consistently short-circuit the financial systems we build. During the South Sea bubble, there were early warnings from critical thinkers like Archibald Hutchison, who correctly calculated the stock's real value was only a fraction of its trading price. But as this 18th century poetry up here beautifully captures, the sheer momentum of speculative greed always outpaces rational thought. The promise of instant wealth creates this frothy illusion that simply blinds investors to the underlying economic realities. So as we look at today's landscape filled with overnight crypto crazes, algorithmic trading, and huge tech booms, I want to leave you with this final thought. We have 400 years of data, regulations, and technological advancements. But have we actually learned anything from the Tulip taverns of 1637 and the trading floors of 1720? Or, deep down, are we still the exact same traders, just inventing faster and more complex ways to repeat the same historical cycles? Take that thought with you the next time you check your portfolio. Thanks for joining me on this explainer, and definitely keep questioning the market.
All right, let's dive right into this explainer. Today, we're dissecting the anatomy of financial meltdowns. We are going to trace the fault lines of the past, specifically looking at the absolute devastation of the 1929 and 2008 crashes to understand exactly how a crack in one tiny part of the financial system can suddenly trigger a worldwide earthquake. And trust me, when you map these events out side by side, the patterns that emerge are truly startling.
It's a question that honestly haunts economists, regulators, and, well, pretty much anyone with a savings account. Could the crash of 1929 happen again? To really answer that, we have to look closely at the mechanics of our financial past and present. We tend to think of history as just a series of isolated events, but when you put the data together, you realize financial history is incredibly cyclical. It's entirely driven by human behavior, regulatory choices, and the complex, often fragile structures we build to manage our money.
I mean, just listen to this bold quote from the Federal Reserve history regarding the Great Depression. "We did it. We're very sorry. We won't do it again." It perfectly sets the stage, right? They are openly acknowledging their past mistakes, specifically the central bank's massive role in making the Great Depression worse. But it really begs the question of whether we can truly prevent those kinds of systemic failures from repeating. Because, as we'll see, saying we won't do it again is a whole lot easier than actually engineering a foolproof financial system.
So here's our roadmap for today. We'll start with echoes of a collapse, then we'll break down the anatomy of the 1929 crash. After that, 2008 and Lehman Brothers, followed by the global contagion effect, and finally, we'll look at the 2010 flash crash.
Okay, part 1, echoes of a collapse, the 1920s versus the 2000s.
Now, you might think the world of jazz and flappers had absolutely nothing in common with the era of broadband and smartphones, but economically, they were practically twins. Academic research explicitly ties these two distinct eras together because the analogies are just undeniable. The decade right before the Great Depression and the decade leading up to the subprime mortgage crisis were both characterized by this exact same deceptive calm.
No major economic contractions, risk premiums were incredibly low, and there was just a massive, overflowing amount of global liquidity.
It's actually eerie how similar they were. Both decades shared this climate of utter overconfidence fueled by rapid growth, extremely low inflation, and an unquestioned blind faith in central banks. In the 1920s, it was the newly formed Federal Reserve. In the 2000s, it was the Fed and the young European Central Bank. People genuinely believed that monetary policy had become so perfectly tuned that severe financial crises were just a thing of the past. And that overconfidence, that was the very first ingredient for disaster.
Moving to Section 2, Anatomy of the 1929 Crash, Black Thursday and the Banking Panics. Let's break down exactly how a standard recession mutated into a devastating collapse.
So the trigger was actually the Federal Reserve trying to cool down massive stock market speculation in 1928 by tightening monetary policy. Then, the stock market famously crashes in October 1929. But the real catastrophe was what came next. In 1930, the Bank of the United States completely failed, kicking off a series of brutal, cascading banking panics. The Federal Reserve totally failed to step in and act as a lender of last resort. Because they basically just sat on their hands, the money supply plummeted by nearly 30% between 1930 and 1933. And when you have that much less money circulating, you get extreme deflation, which forces massive bankruptcies, farm foreclosures, and skyrocketing unemployment.
Now you might be thinking, well, why didn't governments just print more money to stop the bleeding? That brings us to this absolutely crucial concept, the gold standard constraint. Understanding this helps us see exactly how the Depression went global. Because global currencies were directly tied to gold, exchange rates were fixed. If a country tried to expand its money supply to bail out its banks, investors would panic, demand their gold back, and completely drain the country's reserves. So these fixed exchange rates essentially acted like a giant economic straitjacket, transmitting severe financial shocks directly across international borders.
All right, Section 3, 2008, and Lehman Brothers. The subprime burst. We left the gold standard constraint behind, but we ended up replacing it with something infinitely more complex and, arguably, just as dangerous.
Enter the subprime mortgage. The bursting of the housing bubble and the massive wave of defaults on these exact loans is what triggered the 2008 collapse. You see, deregulation allowed banks to bundle up these high-risk mortgages into really complex, supposedly low-risk securities. And for a while, as long as housing prices kept going up, everyone was making an absolute fortune. But the foundation of that entire fortune was built on borrowers who, fundamentally, could not afford the adjustable rate loans they were given in the first place.
And this set off a devastating domino effect driven by insanely aggressive risk-taking. It really started back in 1999 when the Glass-Steagall Act was partially repealed, which completely removed the safety wall between boring everyday commercial banking and highly risky investment banking. Fast forward a few years to 2004, the Fed raises interest rates, housing prices cool off, and those subprime borrowers start defaulting. That completely wiped out the value of those complex mortgage securities. Bear Stearns collapsed early on, but the undeniable climax was September 15, 2008, when Lehman Brothers filed for bankruptcy. Pure panic instantly froze the entire global shadow banking system.
Look at how these two eras line up. In both cases, the failure of a major American financial institution acted as the primary catalyst for severe global uncertainty. Whether it was the Bank of the United States in the 1930s or Lehman Brothers in the 2000s, the shock of a supposedly unshakable giant just falling to its knees entirely shatters market confidence. The main difference? In the 30s, the massive policy failure was central bank inaction. In 2008, it was decades of deregulation that allowed toxic derivatives to silently infect the whole system.
Which brings us to Section 4, the global contagion effect, how financial viruses spread.
Because in an interconnected world, an American financial disaster doesn't stay in America for long. By 1931, the economic virus of the Great Depression had severely infected Europe. The failure of a major Austrian bank triggered an intense, defining crisis in Germany. German banks faced these massive internal drains as terrified depositors rushed to pull their money out, which ended up dragging the rest of the world even deeper into the abyss. This localized panic spread like wildfire, causing a massive run on foreign deposits and ultimately forcing countries, starting with Great Britain, to completely abandon the gold standard.
Fast forward to 2008, and the contagion was practically instantaneous. Lehman collapses, and suddenly there's a global liquidity crisis requiring drastic government bailouts almost overnight. Within weeks, the UK had to rescue Bradford and Bingley. Belgium and the Netherlands had to desperately step in to save their massive banks, Fortis and Dexia. And Iceland? Their entire banking sector collapsed. It completely devalued their currency and forced them to literally beg the IMF for an emergency loan.
To put the sheer scale of this contagion into perspective,
$11 trillion. That is the amount of household wealth wiped out in the United States alone in just under 2 years. When wealth vanishes on that massive a scale, consumer spending stops dead in its tracks, businesses completely stop investing, and the gears of the real economy just grind to a painful halt.
And behind that massive dollar figure is the real human cost. We have to remember that these aren't just abstract financial concepts on a screen. This is real economic devastation. 8.5 million jobs lost, an 11% unemployment rate. When banks are allowed to take reckless risks with wildly complex financial instruments, it is always everyday workers and homeowners who end up paying the ultimate price.
Finally, let's look ahead to Section 5, the 2010 flash crash, algorithms and the new anatomy of disaster.
Imagine watching the market drop nearly 1,000 points, 998.5 to be exact, in just a matter of minutes. That's exactly what happened on May 6, 2010. This was an unprecedented shock, and the scary part is that it was completely detached from traditional economic fundamentals. There was no housing bubble bursting, no gold standard constraint holding us back. $1 trillion of market value simply evaporated, not over months, but literally in the time it takes you to drink a cup of coffee. So what caused it? Well, it quickly became clear that the blinding speed of high-frequency trading and automated systems actually exacerbated the price declines. Early on, people blamed a simple human fat finger typo, but regulators soon realized the issue was incredibly structural. It involved massive algorithmic sell orders and a tactic called quote stuffing, where high-frequency traders just overload the exchanges with rapid-fire orders to create digital noise. The very decentralization of modern trading, spread across all these different digital platforms, created vulnerabilities that algorithms exploited, triggering a cascading, unstoppable domino effect.
It took years for the Great Depression to reach its absolute bottom. It took months for the 2008 subprime crisis to fully unfold. But the flash crash? It proved that in our modern, hyper-connected digital economy, $1 trillion can vanish and reappear in exactly 36 minutes. The fundamental speed of a financial crisis has completely shifted.
Which leaves us with this provocative thought to ponder. We've mapped out how deregulation, central bank failures, and now high-speed algorithms have repeatedly devastated our traditional financial systems. Is it any wonder then that just months after the 2008 crash, a mysterious figure named Satoshi Nakamoto launched Bitcoin? These cascading historical collapses literally paved the foundation for decentralized finance, a movement seeking to replace those vulnerable centralized institutions with trustless mathematical code. So as you look at the financial news tomorrow, ask yourself, is the future of money just a patched-up version of the old system? Or are we heading toward a completely decentralized new one? Thanks for joining me on this explainer, and keep learning.
Okay, today we're going to unravel one of the most complex players at the heart of the 2008 financial crisis. You've probably heard its name before, the credit default swap.
So to get the whole story, we have to go right to the scene of the crime. The chaos of 2008, when the global economy was teetering on the absolute edge of a cliff. Now, a lot of things got the blame, but there was one financial tool that just kept popping up everywhere.
And this wasn't just hindsight. Way back in 2002, the legendary investor Warren Buffett gave this incredibly chilling and accurate warning. He basically described a time bomb ticking away quietly right at the center of the world's economy. At the time, though, not many people were listening.
Well, that time bomb started to go off right in the U.S. housing market. You can see it here. Foreclosures didn't just go up, they skyrocketed. I mean, millions of families lost their homes, and those shockwaves started spreading out, shaking the very foundations of the entire financial system.
So that really brings us to the core question, right? How on earth did one single, kind of obscure financial product, something most of us had never even heard of, become a key ingredient for a global economic catastrophe?
To get that answer, we've got to meet our main suspect, the credit default swap, or CDS. Now I know, it sounds super complicated, but its original purpose was actually pretty simple.
In its simplest form, a CDS was just a clever way to handle risk. Think about it like this. Back in the day, JP Morgan had a huge loan out to a big company, Exxon. They were a little nervous, so they paid another bank a fee. And in return, that bank promised that if Exxon ever went bust and couldn't pay, they'd cover JP Morgan's losses. Simple, right? It's just a way to move risk off of your books and onto someone else's. So the key takeaway here is that a CDS basically works just like an insurance policy. The lender buys protection, and the seller of that protection gets a regular payment, kind of like a premium. If everything goes smoothly, the seller just keeps the cash. If the borrower defaults, well, then the seller has to pay up.
It was actually designed to make lending safer.
But, and this is a huge but, this simple little insurance tool, it did not stay simple for long. What began as a smart idea for managing risk quickly mutated into this unregulated multi-trillion-dollar monster.
Just look at the sheer speed of this growth. It's wild. In late 2004, the total value of loans being insured by these things was about $6 trillion. Less than 4 years later, it had ballooned to nearly $58 trillion. That is an absolutely mind-boggling explosion, and it was all happening in the shadows, with almost zero regulation.
So what was fueling this? Well, the whole purpose of the market changed. It went from what we called hedging, where you buy a CDS to protect a loan you actually hold, to pure speculation. This is the critical twist in the story. People started using CDSs to bet on the failure of companies and loans they had absolutely nothing to do with.
And this is the perfect analogy. It's like being able to buy a fire insurance policy on your neighbor's house, or on 100 of your neighbor's houses. That's exactly what was happening. You could place a bet that something would fail without owning any piece of it. All of a sudden, the game wasn't about preventing disaster, it was about profiting from it.
And this wasn't just some small corner of the market, this became the market. By the time the crisis hit, estimates suggest a staggering 80% of all CDS contracts were held by speculators, people just making bets. The original purpose was completely buried.
To pour even more gasoline on the fire, these bets were highly leveraged. What does that mean? Well, think of it this way. For every $1 an investor actually put down, they could control a bet worth $30. This massively magnified their potential profits, sure, but it also meant that when things went south, the losses were absolutely catastrophic.
Okay, so we have this massive, speculative casino operating in the shadows. How did it end up becoming the perfect accelerant for the firestorm that was already brewing in the U.S. housing market?
So the first spark was the housing bubble. You had low interest rates, really loose lending standards, and banks were handing out millions of what they called subprime mortgages. These were basically high-risk loans given to people who honestly probably couldn't afford to pay them back.
Now, Wall Street thought it had a brilliant solution for this. The banks didn't want all this risky stuff on their books, so they bundled thousands of these mortgages together into these complex bonds. They basically took thousands of little risks, put them in a big financial blender, and sold that cocktail to investors all over the world. They thought, hey, the risk is now someone else's problem.
And this is where the credit default swap comes roaring back into the picture as the accelerant. To make these bundles of bad mortgages look safe, banks bought CDS protection on them. They essentially slapped an insurance sticker on them. And this created this powerful illusion of safety, convincing investors that even bonds backed by the worst loans were somehow a rock-solid investment.
And that created the perfect storm. This false sense of security from the CDSs just encouraged more and more reckless lending. But the risk never actually went away. It was just hidden, tangled up in this complex web that stretched across the entire globe. So when homeowners inevitably started to default, the whole house of cards just came crashing down. The mortgage bonds became worthless, and the companies that sold trillions of dollars in this insurance, like the huge insurer AIG, were suddenly facing losses they could never, ever pay. One domino hit the next, and the whole system started to fail.
The world really stared into the abyss. A massive government bailout was needed to stop a full-blown global depression. So, after all the dust settled, what did we do to stop this from happening all over again?
Well, regulators stepped in with some big reforms. The goal was to drag this whole shadowy market out into the open. To stop that domino effect, a lot of these trades now have to go through a middleman, a central clearinghouse. To fix the secrecy problem, trades now have to be reported, so everyone can see what's going on. And to make sure banks can actually survive a crisis, they're now forced to hold way more cash in reserve.
And that brings us to our final thought. The credit default swap went from a pretty clever idea to a weapon of financial mass destruction. We have new rules and new safeguards now, but in a world where financial innovation never stops, you have to ask, is the beast truly tamed? Or is it maybe just waiting for its next chance to strike?
Have you ever wondered how the simple, seemingly harmless desire to own a home managed to accidentally trigger a catastrophic global economic collapse? I mean, it sounds almost impossible, right? How does a family buying a house in the suburbs lead to the meltdown of centuries-old financial institutions and worldwide panic? Well, stick around, because in this explainer, we're going to untangle the exact mechanics of how this unbelievable chain of events actually unfolded. To really grasp the sheer scale of the destruction, just think about this number: $11 trillion. That's the mind-boggling amount of household wealth that just vanished in the United States alone between the market's peak in 2007 and rock bottom in early 2009. We aren't just talking about Wall Street profits evaporating here. We're talking about everyday savings, retirements, and the net worth of regular people just completely wiped off the map. Okay, let's dive into this. Welcome to our explainer on demystifying the 2008 financial crisis. You know, it's an incredibly dense and often misunderstood topic, but we're going to break down the exact perfect storm that brought the entire global economy to its knees. So here's our roadmap. We'll start with the setup, examine the flawed foundation, hit the climax with the 2008 meltdown, and then wrap up with the government rescue and the global fallout. Let's get right into it. Section 1. The setup. The illusion of prosperity. Back in the early 2000s, as the economy was bouncing back from the dot-com bubble, aggressively lowered interest rates collided with what economists call the global savings glut. Basically, a massive surge of foreign capital, largely from Asian economies and oil-exporting nations, just flooded into the U.S. This absolute mountain of foreign cash subsidized U.S. borrowing, which kept interest rates artificially low. Suddenly, everyday consumers had incredibly easy access to cheap credit. And, well, what do people buy when credit is cheap? Houses, of course. Now, what's really interesting about this is how that flood of cheap credit completely distorted reality. Historically, like during the 1980s and 90s, the median U.S. home price was about 3 times a household's median income. But by the 2006 peak, that ratio had absolutely skyrocketed to 4.6. People were using borrowed money to bid up homes way beyond what their actual incomes could support. It was, literally, the textbook definition of a bubble. Which brings us to Section 2, the flawed foundation, the rise of risky lending. With home prices soaring, Wall Street and mortgage lenders were hungry for astronomical profits, but they were running out of prime borrowers, so they aggressively pivoted to the subprime mortgage. Now, you probably already know these loans carry a significantly higher risk of default, right? But during the mid-2000s, Wall Street eagerly swallowed this massive risk whole, all just chasing the incredibly lucrative fees generated by initiating these lower credit loans. The underwriting practices during this time became almost comically reckless. Lenders were dropping required FICO scores below 620 and pushing what they called ninja loans. And yes, that literally stands for no income, no job, no assets. They were even openly referred to as liar loans because borrowers could state whatever income they wanted with absolutely zero documentation. People were being handed hundreds of thousands of dollars with practically no proof they could ever pay it back. It was wild. And this brilliantly illustrates how Wall Street tried to hide this massive vulnerability through securitization. Banks bundled thousands of these risky subprime mortgages together to form complex products like mortgage-backed securities and CDOs. Then, and this is the shocking part, credit rating agencies mistakenly slapped their safest, lowest-risk AAA ratings on them. So these incredibly risky individual loans were magically transformed into supposedly safe global investments through sheer financial alchemy. Now, when analyzing how this was even allowed to happen, there's a fierce debate detailed across our sources. On one hand, some argue government policy was at fault, pointing to mandates and government-sponsored enterprises like Fannie Mae and Freddie Mac that basically forced affordable housing quotas and encouraged lending to higher-risk borrowers. On the other hand, many blame Wall Street deregulation, specifically pointing to the repeal of the Glass-Steagall Act, which enabled depository banks to gamble just like investment banks, fueling predatory lending and unchecked greed. Ultimately, looking at the data, it was likely a perfect storm of both, flawed government housing policies colliding head-on with rampant financial deregulation. Moving on to Section 3. The 2008 meltdown. The House of Cards collapses. By 2006, housing prices peaked and finally started to decline. Borrowers suddenly couldn't afford their adjustable rate resets, defaults spiked, and a massive liquidity crisis followed. As those supposedly safe bundled mortgages plummeted in value, banks woke up and realized they were sitting on billions in toxic assets. The problem? Nobody knew exactly who was holding the bad debt. Unable to trust each other's solvency, banks simply stopped lending cash. The entire global financial system just completely seized up. The panic that followed was historic, just absolute freefall. In March 2008, Bear Stearns is bailed out and sold in a fire sale to JP Morgan. Fast forward to September 7th, the U.S. government seizes Fannie Mae and Freddie Mac. September 15th, Lehman Brothers files for bankruptcy. The very next day, September 16th, the U.S. bails out AIG, the world's largest insurer. 10 days later, Washington Mutual is seized, marking the largest bank failure in American history. Boom, boom, boom. So the crucial point here is this number, 777.68. On September 29th, after Congress initially rejected a massive bank bailout package, the Dow Jones plummeted by that exact number of points in a single day. At the time, it was the largest single-day point drop in history. The market was sending lawmakers an absolutely terrifying message. You have to do something right now or the entire economy will disintegrate. That takes us to Section 4, the government rescue, unprecedented action. The sheer scale of the panic forced world governments into truly unprecedented action. Congress reversed course and authorized a staggering $700 billion for the Troubled Asset Relief Program, or TARP. The Treasury was literally buying toxic, plunging mortgage assets directly from failing banks, just to inject them with desperately needed cash. But they didn't stop there. Central banks worldwide, including the Federal Reserve, went from being the lender of last resort to what some called the lender of only resort. They slashed the federal funds rate all the way down to 0%. They initiated a highly controversial program called quantitative easing, which basically meant pumping trillions of dollars of liquidity straight into the financial system. They insured vulnerable money market accounts and purchased vast amounts of troubled private assets. It was the largest monetary policy action in world history, an absolute flood of cash designed to unfreeze the credit markets.
Finally, Section 5, the global fallout, the Main Street impact. You know, the bailouts might have ultimately saved Wall Street, but the long-term consequences absolutely devastated Main Street. 8.7 million. That is the staggering number of jobs lost in the United States alone. Unemployment doubled, hitting 10% by late 2009. The percentage of citizens living in poverty rose sharply, and countless families faced evictions and foreclosures. The complex financial engineering of Wall Street caused very real, very devastating human pain. Scrambling to rewrite the rules of finance and prevent a repeat, lawmakers passed the 2010 Dodd-Frank Act and the global Basel III standards. The core goal here? To increase bank capital and protect consumers. Basically, they wanted to force banks to hold significantly more actual cash on hand, ensuring they could survive future economic shocks without ever requiring your taxpayer dollars to bail them out again. Looking at the broader macroeconomic picture, this crisis fundamentally shifted world power. The data really speaks for itself. In the decade following the 2007 crash, global growth was driven heavily by emerging economies. China added an unbelievable $14 trillion to its economy, followed closely by India. Meanwhile, the US and Europe, bogged down by a sluggish recovery, sort of took a backseat as the engines of global growth dramatically shifted eastward. I want to leave you with this thought from Charlie Bean, who was the deputy governor of the Bank of England back in 2008. He said, "This is a once-in-a-lifetime crisis, and possibly the largest financial crisis of its kind in human history." We've seen how easy credit, reckless lending, and complex financial engineering built a colossal house of cards that nearly took down the modern world. So the question we have to ask ourselves now is, are the new rules we put in place truly enough to prevent the next house of cards from falling? Thank you for joining me for this explainer, and keep asking those critical questions.